This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Asian stocks poised to follow Wall Street lower as traders hold back risky bets ahead of key U.S. inflation data. Oil wavers on mixed diplomatic signals about the Strait of Hormuz. A positive leaning, though, for Asian tech with strong earnings from CoreWeave and Supermicro, while credit concerns ease around NVIDIA's $500 billion AI financing plan. And South Korea preparing to pump more than $700 million into a new fund targeting AI and other strategic industries. We hear exclusively from Deputy Innovation and Growth Minister Min Kyung-seol.
And I'm Haidi, Stroud-Watts in Sydney. Take a look at the setup for trading across Asia as we hit midweek. And we do have really that pullback of risk is as expected, given that we are expecting that key US inflation print on the back of the surprising job numbers that came through at the end of last week, which has shaken up some of these Fed path forward expectations. But we are watching the situation when it comes to geopolitics. Oil mostly holding on to that 4-day gain still. Brent crude last trading higher by almost 1.5%. We're seeing New York traded crude modestly to the upside, still over that $80 a barrel level. Traders monitoring these efforts to reach a deal that could, of course, help reopen the Strait of Hormuz and restore these energy flows. We're hearing from the Defense Minister of Pakistan saying that Washington and Taiwan are close to some sort of agreement. We're also hearing some advanced progress when it comes to the talks between Iran and Oman as well, but still quite a lot of uncertainty there. When it comes to broader equities, this is the picture as we have US futures, or I should say the last trade when it comes to US stocks off by 0.3%. Korean futures looking like we'll get some upside from the tech headlines that we just went through previously with Shery, and we're watching Chicago Nikkei futures there as well. Dollar yen at that 159.27 level as we continue to see that inching forward towards 160 to the dollar, raising again these new intervention concerns. Shery.
Haidi, CoreWeave and Supermicro shares surging during after-hours trade as well after both companies raised their sales outlooks, reinforcing expectations that AI infrastructure spending remains robust. Let's get more from Lin Doan, our managing editor for U.S. tech and cybersecurity. CoreWeave, of course, Lin, is not just one of those bellwethers when it comes to the neo-cloud AI model, but also at the same time, some of their customer base, just giants like OpenAI, Meta, Microsoft. What could we tell about the broader AI boom?
That's exactly right, Shery, and thank you for having me. CoreWeave is not just a bellwether for the neoclouds, these AI cloud suppliers. It really is a gauge of how overall AI computing demand is faring. And what this sales outlook is telling us, and the fact that they smashed those estimates and fell at the very top end of the range, really, that analysts were expecting, just goes to show that the AI demand for cloud computing remains strong. Not only were the sales strong, the backlog that they gave, which is a very closely watched measure of future sales, reached $104 billion at the end of the quarter, which is just incredible for this company that only went public not too long ago.
And we had already heard from Supermicro as well just last month how their backlog was at a record. Did we get sort of a similar AI demand story from this company as well?
Yes, it was very similar. They aren't in the same business. Supermicro makes the servers that the chips go into. CoreWeave rents out or purchases or leases those servers to sell back to people who need the AI cloud computing. But Supermicro's results tell a very similar story in that they gave a sales forecast for the current quarter that very much topped analyst estimates, and that was yet another sign of booming AI demand. Now, what I thought was interesting about Supermicro was, it's funny, I said it's a bit of a toss-up when it comes to how the market will react, because as you said, last month they already released preliminary results, right? And the market went up about 25% as a result of that. So I thought maybe it's all baked in and they won't react, but they exceeded expectations despite those preliminary results, and we're up very much in extended trading today as well.
And of course, a big one is coming up, NVIDIA's earnings. What can we expect?
Yeah, so NVIDIA reports on August 26th. And of course, the big news from last night going into this morning was the fact that they had tapped a bunch of big Wall Street names like Apollo and BlackRock and Blackstone and said, hey, if you're looking for financing for our chips, for AI infrastructure, come through us and we will hook you up with one of our Wall Street partners. That is very much indicative of what NVIDIA is trying to do here, which is to reinforce the idea that AI demand remains strong, that this is not a house of cards, that this is not artificially inflated demand, that the demand is real. And, Supermicro and CoreWeave and the results they have very much bolster that argument. So maybe NVIDIA doesn't have to worry about that as much as it obviously has been in recent days.
We have heard some reports about NVIDIA's wanting to develop this open source model. So what do we know?
There was a report out by another media outlet about the fact that it really is putting a lot of resources and working on advancing its open source models. This is an ongoing effort. And quite honestly, it's exactly what I was talking about just now, about how NVIDIA is trying to build this ecosystem and reinforce the demand for its products. What better way to reinforce the demand for NVIDIA's AI chips than to put out a bunch of open source AI models that seed the market and increase the demand for its chips? So that's the end game here. It's not like NVIDIA is, striving to be the leading AI model developer of the world, but having AI models out there are going to increase the demand for its hardware.
Bloomberg managing editor for US tech and cybersecurity, Lynn Doan there. Well, Asian stocks are poised broadly to follow Wall Street lower as traders are holding back on any risky bets ahead of key US inflation data. Let's take a look at the broader outlook. I want to bring in Bloomberg M Live strategist Mark Ramfielder. So, unsurprising that we're not seeing a whole lot of risk-taking at this point.
Yeah, the CPI numbers are huge as far as investors are concerned, as you've just been hearing, even though companies like CoreWeave are producing great results, beating estimates. The SOX index overnight, the Philadelphia SOX index, only rose by a relatively small amount. That will be some encouragement to what we see in Asia today, may help Korean stocks get off to a good start. But really, it's all about that inflation number, because if the core CPI numbers stay on the high side, then people will expect the pressure on the Federal Reserve to get even greater and possibly to see an interest rate increase in September. That's the biggest factor really in the near term for markets. In some ways, it's even more important than whatever happens in the Middle East. Even we may or may not get a deal to reopen the Strait of Hormuz. Oil prices have stayed relatively high, but at least they're not up to $100 a barrel just yet. So there's volatility and some swings in the oil market, making people a little bit nervous. But by far, the CPI report is the biggest thing on the agenda for the next couple of weeks, really. So if we get a reinforcement that the Federal Reserve needs to do something at the September meeting, that will be a very big shakeout for markets. Or on the other side, there will be a huge relief. If we get inflation numbers which come in below expectations, the market will be much happier about that, and we can probably see stocks start to perform much better. So it's understandable if traders don't want to take huge positions going into that number. You can see why the concerns are there that whichever way, we're going to get some pretty high volatility, either positive or negative, once those numbers drop tonight in New York.
It's interesting. We've seen these markets, equity markets at least, pretty happy to ignore the negative, right, when it comes to the ongoing geopolitical situation. Do you think a deal on the Strait of Hormuz could have upside that's perhaps more meaningful?
Yeah, certainly any peace deal will be a relief for markets in general. We've seen it every time there's a suggestion. We saw it just last night when Pakistan authorities were saying that US and Iran were getting close to some sort of agreement on Hormuz. We saw that there was a little pop higher in the markets, and Treasury yields came down, which was probably more significant. The fact that people are concerned that the extended period of high oil prices is really pushing up the long end of the Treasury curve. That's a major concern for people. So anything which deflates that is clearly good. But what we've learned over the past few months is, despite the US-Iran situation, which has been going on for several months, American companies especially, global companies in general, but particularly the big companies in America, continue to make very substantial profits. They're somehow managing to get around the the bottlenecks and the supply chain issues, and they're still producing great numbers. This earnings season has been another very good one in the US. So as we look forward to NVIDIA, people are reassured that these big names, they can beat estimates regardless of what is happening in the Middle East, regardless of whether oil is near $100 or not. So there's a lot of optimism there. No wonder the S&P index continues to make record highs and we stay in an elevated position like that. Looking ahead, people are still very optimistic. It would need a really huge shock from the oil market, probably something like going back to $120 that we saw in March, before people start to get really negative on the outlook for global stocks, let alone US stocks.
Also, perhaps a very big shock needed in order to support the yen on a sustainable basis. I mean, we're very close to that 160 level against the US dollar. Again, we're coming back from Mountain Day holidays here in Japan. How much would an early BOJ hike help in this scenario? Bloomberg Economics just bringing forward that call, which was for December, now to an October hike.
Actually, it would probably need back-to-back hikes. If you look at the 2-year JGB yield is a very good indicator of where people's expectations are for what's going to happen with the Bank of Japan. Currently, the spread between 2-year yields and the target rate is almost as wide as it was at the end of May, which was just before the Bank of Japan raised interest rates in June. We're back up to those kind of levels, and we're approaching a time when there are going to be 3 Bank of Japan speakers coming up in the next couple of weeks. They've been pretty quiet since the intervention between the US and the United States, between the US and Japan, to satisfy the yen market. So the BOJ speakers will really have a big sway on whether or not people get serious about a September rate hike. But it probably needs September and October to come back to back for people to really get behind the yen. We've been disappointed. Traders have seen a lot of talk about the Bank of Japan moving early. But when you think that the neutral rate is something like 2%, and we're only at 1% now, we probably would need to see 25 plus 25 in a short period of time for people to take the Bank of Japan seriously, that they're trying to get ahead of the inflation situation. People have known that core inflation is sticky in Japan for a long time. It's not expected to come down anytime soon. So whichever way you cut it, the Bank of Japan is behind the curve. No wonder there's been so much talk about it. Traders, investors, they know this. They want to see the Bank of Japan get more aggressive. Let's see what those speakers have to say. 2 of the 3 speakers coming up are known to be hawks, but they need to drive the message across and get the market excited that they're going to vote for a hike in September and follow it up in October. Anything less, and the yen will probably stay as a big underperformer, and we'll have to look towards intervention yet again to stabilize the currency.
Bloomberg M Live strategist Mark Cranfield there with his views on what's happening across markets, as we're also following the latest economic data out of South Korea. We are getting now the adjusted jobless rate coming in at 2.8% for the month of July. This is rising from the previous month, also coming in above expectations. We are also seeing that the population over 15 years old has increased slightly to 0.6% from a year ago. We will continue to follow these job numbers because, of course, we have seen the impact from the Iran war supply disruptions weighing on petrochemicals, construction weakness, which has really partly offset some of those gains by the tourism and services side of things. In today's session in South Korea, Haidi will also be watching some geopolitical tensions. We're now hearing from local media that North Korea's missile flew more than 700 kilometers on that announcement earlier that we had heard from Japan as well, confirming that North Korean suspected ballistic missile. Haidi.
Yeah, Shery, staying with geopolitics and taking a look at this potential deal that Pakistan says is getting closer between the US and Iran over the Strait of Hormuz. They're saying that even as the two sides appear to be hardening their positions, we'll get the latest next. This is Bloomberg.
We're We're keeping an eye on risk assets after Pakistan's defense minister said the U.S. and Iran were close to some sort of arrangement over the Strait of Hormuz. Meanwhile, a new report from Bloomberg Economics says the Pentagon's stocks of hard-to-replace air defense interceptors and long-range missiles are dwindling. For more, let's bring in national security reporter Courtney McBride. Courtney, let's start with the state of play here around Iran, because we're getting different comments when it comes to the Oman deal track with the U.S.-Iran negotiations. Where are we at?
Certainly. We're hearing optimistic messaging from Pakistan and a little bit of hardening of rhetoric, both from the U.S. and from Iran. It's hard to say, that a deal is really close, despite the optimism out of Islamabad. The status quo of sort of low-level strikes, including today, U.S. forces hitting a ship that tried to break their blockade, seems to be more likely to continue. The Strait of Hormuz does not appear to be opening anytime soon, despite this optimistic messaging we're hearing.
And we've heard recently some more patient rhetoric coming from President Trump. What do we know about the state of arsenals, especially around some advanced weapons? We kept hearing media reports, but I understand that we have a new Bloomberg analysis on where we're at.
Absolutely. I think some of the reporting may have conflated defensive and offensive weapons. And one of the things that we tried to clarify with the report from Bloomberg Economics was the distinction between the air defenses, which are heavily prized, difficult and slow to produce, and really critical to protecting U.S. forces, installations, and allies and partners around the world. Those are in rather dire shape. The U.S. certainly has enough offensive weapons to continue striking targets in Iran, but what really starts to come into question is the ability to protect U.S. forces, and potentially, this could affect decision making by the president, by the military, for potential future conflicts, including potentially in Asia.
And yet, when it comes to the shipping environment right now, it seems that it remains as an active conflict territory. We're hearing from U.S. Central Command that more missiles have been fired against cargo vessels as well. What do we know in terms of the state of these different waterways and where U.S. personnel is at the moment?
Absolutely. So, the U.S. military has an array of warships. Central Command has indicated that more than 20 U.S. warships are detailed or deployed in the region right now, enforcing that blockade of Iran-linked ships, including today, U.S. forces fired 2 Hellfire missiles at a Panama-flagged vessel that was attempting to break the blockade. So that continues. It resumed July 14th, and the U.S. has redirected 55 vessels since then and fired upon now 3. Meanwhile, the Red Sea, which had been an alternate route, is itself now an issue with the Houthis joining the fight.
Bloomberg national security reporter Courtney McBride there. Well, New Zealand markets are in focus today ahead of a crucial meeting for Prime Minister Christopher Luxon. He's called an emergency gathering of National Party lawmakers as he seeks to end speculation over his leadership ahead of November's election. Bloomberg's Paul Allen joins us now with more. So I guess ending this speculation one way or another. How did we get here, though?
Well, there's polling, effectively, which is usually the reason for coming to this point. It's not great. The national government could get back, but only just. We'll have more on that in a moment. But, when Chris Luxon won government back in 2023, the polling of the National Party was 38%. Now it's in the high 20s. Things really came to a head, though, for a number of reasons in the past few weeks. First, Chris Luxon made some unfortunate comments about small business leaders, told them they were being negative. and should stop looking to the government for help. He had to walk that back. Then he made a rather confusing call to revisit through referendum New Zealand's electoral system, MMP. That blindsided colleagues as well. But since then, also the New Zealand First Leader, Winston Peters, who is the foreign minister, is in coalition with the government, made some very disparaging remarks about a Chinese-born Greens MP, so bad that it provoked the ire of China as well. Now, there was a call for Chris Luxon to sack Winston Peters, but he can't really. He's the foreign minister, also the leader of the coalition partner. That would mean the end of the government and heading to an early election with the polls in a dire strait. So this is actually the second time we've been here. Chris Luxon called a vote back in April to bring this to a head. He won that, but it hasn't gone away.
It's quite extraordinary how far things have swung since the election, right? But you mentioned Winston Peters. Is he one of the names that could possibly be a replacement?
Well, that would have to happen at the election, and Peters would have to win the majority of the votes. Within the National Party itself, there are options. None of them are great. Chris Bishop is the Attorney General, is a front-runner. He publicly supports Chris Luxon. Another option is the Education Minister, Erica Stanford. But her own friend and Minister for Women said this morning, heading into the caucus meeting, that Stanford's not Prime Minister material. So that kind of puts a line through that. Nicola Willis, the Finance Minister, another potential option, although might be seen as being too close to Chris Luxon. But none of these are good options. We're 87 days away from the election, and history suggests when political parties do this, it's usually in an effort to save the furniture. In this case, the best hope the national government has is the opposition Labour Party, which is actually polling even worse. So right now, it's not just the National Party. This New Zealand as a whole is faced with this menu of political choices and doesn't particularly like any of them.
Thanks, Paul Allen. There with the latest. We'll bring you the details if there's an outcome from that emergency meeting. More ahead on the Asia trade. This is Bloomberg. Let's get you caught up with the latest on the corporate front. And Australia's Commonwealth Bank has reported stronger than expected annual profit, with growth in mortgage and business lending helping offset signs of a cooling housing market. Cash profit climbed 7% to $7.8 billion in the 12 months through June. Australia's largest lender also raised its dividend, while noting that economic pressure from higher interest rates and inflation. US listed shares of Singapore-based CE surged after the company raised full-year earnings guidance for its e-commerce arm, Shopee. The upgrade suggests that Shopee is holding off intense competition from rivals including TikTok Shop, Lazada and Temu. The company also reported ad revenue jumping 70% in the second quarter, Shery.
And Heidi, take a look at how alternative asset managers have performed. They're actually doing better than financial peers. Not surprising, given that we're seeing this increasing role of private capital in the AI build-out, especially with the latest announcement from NVIDIA, that $500 billion Wall Street AI financing coalition, which includes the likes of Apollo, KKR, Blackstone, BlackRock, Brookfield, Goldman Sachs as well. And we have now seen a little bit of NVIDIA's credit risk, at least, easing. CEO Jensen Huang clarifying that NVIDIA would support up to 25% of an opportunity on a project-by-project basis, describing that support as residual value-based and complementary to independent underwriting. Remember, we had a lot of concerns around this deal when it came to the direct exposure of NVIDIA when it comes to all of this AI build-out spending, and also a little bit about the circularity question. We have more ahead. This is Bloomberg. And Heidi, of course, we have drum rolls to the US CPI number, especially given that we had that softer than expected jobs numbers. If in fact we do actually get a soft CPI print too, we could all but sort of rule out a potential September rate hike coming from the Fed. Of course, at the same time, on the other side, the risks are skewed to the upside when it comes to the price of oil, to the really risks around what's going to happen to the Strait of Hormuz. But at least when it comes to the July CPI numbers, right now the expectation from Bloomberg Economics is that we're going to see a second straight tame report. Core CPI could come in at the lowest levels year on year since March of 2021 because that tariff pass-through appears to be largely complete. Not to mention that we have seen lower metals prices, so that could reduce the pressure. Of course, very significant for what happens to the US dollar, right? And what happens on the other side of the US dollar trade, which is the Japanese yen, which is already weakening again, giving up half of that rally that we've seen since the US-Japan intervention.
Yeah, and you mentioned the sort of inflation print, and if that sort of comes across as benign, at least that takes a little bit of risk and pressure off the table, given that we know that there is still going to be pass-through from this ongoing standoff between the US and Iran, and the lack of progress that we're still seeing when it comes to the reopening of the Strait of Hormuz. We're hearing that potentially there is a little bit more progress there, despite what it appears that both sides in recent days have really been kind of firming their stances, right, and getting further away from an agreement rather than closer. But if you take a look at New York traded crude at the moment, we're still holding on to gains for a fourth straight day, watching the potential for a deal with Pakistan's defense minister saying that the two sides are close to some sort of agreement on being able to reopen the Strait of Hormuz. In the meantime, we do have the latest reports from the EIA, the US regulatory body when it comes to energy. Their outlook is that these supply disruptions from the war will reach about 600,000 barrels per day through to the end of next year. So these disruptions could continue through to 2027. Obviously, that comes through in the inflation basket as well. A big part of that obviously has been the implications for various industries. The elevation of jet fuel prices have become a major financial challenge for some Asian carriers this year, impacts ranging from sharp profit declines to outright losses. Our next guest leads the industry body representing these airlines across the Asia Pacific with 18 members, including the likes of Cathay Pacific, Singapore Airlines, Qantas among them. Joining us now is Wong, who's the Director General of the Association of Asia Pacific Airlines. Really great to have you with us, and belated congratulations on the job. I know that you've been here since April. A very eventful time for you to be overseeing the airline industry in this part of the world.
Indeed. I think joining in April and since stepping into this role, every airline has been facing big challenges insofar as having to deal with their fuel prices. This has set back many carriers, I think, in the last three to 4 months. Although what we're seeing now is, prices have come off. I think jet fuel prices are now a lot less than $200 and above. They're still pretty high, I would say, in the range of around 150, 170. So, that's a massive headwind as far as airlines are concerned. And going forward, and then there continues to be some degree of uncertainty as to how much fuel prices would be able to come off.
Well, that's it. And even, as you say, even though it's come off, we're still sort of roughly double from the start of the year or prior to the war,
Correct.
Give or take some amount. So how are you seeing individual carriers weather that, and how's that passing through to traveller demand?
Yes. Well, you see fuel surcharge charges applying, and fares have generally gone up. But by and large, I would say most carriers are quite glad to see actually demand still holding out pretty well. We just come off the summer period right now, and I think bookings are still holding up quite well, which is a good relief. But still, nonetheless, all these fare increases, fuel surcharges that we're seeing, they're really not sufficient to offset the increase in costs, which is why you see from the April to June set of results that are coming out from various carriers reporting, many of them, would reflect that cost. On the top line side, revenues are still holding, which is a reflection, of course, of the strength in bookings. But as far as costs are concerned, that's still a headwind.
Does the strength in bookings tell you that the average traveller is actually quite resilient to higher prices?
Yes.
Does that mean prices might stay high?
It may hold at these levels, I would say, but I think airlines are very sensitive, of course, to how bookings are coming through. And coming off this particular summer, I think what's important is looking ahead towards the end of the year and see how bookings are actually coming through. The other potential risk, of course, is whether customers are going to get used to these levels or are they going to come off. And then the other ugly risk that people are concerned about is whether there's inflation also going to be kicking in, and that might impact, obviously, the degree of bookings.
The flip side of that resilience is I do wonder if you're seeing any indications of unfair pricing or price gouging over the past 6 months.
I wouldn't say so. I think if you see that happening, I think prices obviously are very, very sensitive, and they would adjust very quickly. At this point, from what my observations around the region, that hasn't really been the case.
The recent half-year traffic stats actually show a dip in passengers overall of just over 1% year on year. For the next 6 months, rest of the year, what's your outlook?
I would say we are a little bit tentative, meaning to say, the first 2 to 3 months, July, August being the summer, I think we're going to have a decent set of top-line revenues coming through. But I think the risk is obviously coming off that from the final quarter of the year. I suspect that might be some headwinds that we would see as far as demand also. Cost, I suspect, it's really hard to tell, given the changes in condition. But of course, we all want to see a better relief coming out from the Strait of Hormuz, where fuel prices maybe can ease off. It is still high. I think nonetheless, airlines are pretty much prepared. Some airlines are hedging, and even if they're hedging, I think their prices have already gone up. And those that are not, are just completely exposed, and that continues to be a risk for airlines operating into the end of the year. So they have done some adjustments. Some airlines have started to rationalize some capacity, maybe cutting some flights from 6 flights a day to 2 or 3 flights a day. As far as short haul frequencies are concerned, some have cut back on some capacity to some degree, but I think it's a different strategy for different carrier.
That's interesting, because you're saying even the ones that have secured hedges, they are starting to expire as this drags on?
Yes, indeed. Usually when the hedges expire, they would renew these hedges, but at different levels, right?
Yeah.
So these prices have clearly gone up, and it will be a higher cost that the airlines would have to bear, reflecting the more current level of pricing.
What do you think the summer season for earnings will look like then? Profitable still, strong, or do you think you'll start see some of the weakness?
Yeah, I think it's a bit hard to say, simply because I think when I'm talking to my member airlines, and what I'm sensing is that the demand is still pretty good, which means I think the top line revenues are going to still hold on with some growth. However, are they enough to offset, the costs that are being, that they have to carry? I think that will be certainly a big risk for them.
What do you think are the broader risks if we kind of try and look beyond the impact of the war and of costs? What's the biggest risk that certainly your members are concerned about in the long run?
Well, there's some of the other issues that the airlines have been facing hasn't really gone away. Things like supply chain, the delays and backlog are still there. These have emerged post-COVID. Sort of last 2 to 3 years, airlines have been facing these backlogs, both from the manufacturer standpoint as well as from the engine suppliers. So these combine to actually produce or actually cause an effect, a delay in terms of the aircraft that's being delivered, and then that translates obviously to other consequential risks. Airlines now hold on to the older planes, but that's also a reflection because there are still decent demand that's coming through.
Really great to have you with us. We appreciate your time. Wong Hong, who's the Director General at the AAPA. More ahead here on the Asia Trade. This is Bloomberg.
South Korea is looking to deploy over $700 million of fresh capital into a new account within the Sovereign Wealth Fund next year, targeting AI and other strategic industries. Deputy Minister for Innovation and Growth Kyung-seol told us exclusively about the government's latest push to gain an edge in high-tech sectors.
한국 정부는 특히 이제 최근에 와서
The Korean government, particularly recently, has been actively considering various ways to enhance international competitiveness and raise the declining potential growth rate through active investments in key high-tech strategic industries. Internationally, as recently discussed, we are pursuing active investment in regional areas, including the Honam region, for 3 major mega projects. Along with this, as a new initiative, we are actively pushing forward to establish a sovereign wealth fund, which we refer to as a strategic sovereign wealth fund, to actively lead investments in high-tech strategic industries. Through this, we aim to actively foster potential growth and proactively fulfill a role in responding to future challenges such as population decline and increasing fiscal demands of various forms. Internationally, we understand that various types of investors, including sovereign wealth funds, PFs, and sovereign wealth funds in general, are considering investments in Korea. To serve as an anchor investor to attract investment into Korea and co-invest alongside these key international global investors, we are pushing for the establishment of this sovereign wealth fund.
How much deployment are we talking about, for example, in a year out of this 20 trillion won?
For next year, while exact details are difficult to specify, we estimate the investment amount could range from roughly 600 billion South Korean won on the lower end to over 1 trillion South Korean won on the higher end.
Korea operates multiple state investments when it comes to these innovation technology sectors. So how do you make sure that this new account doesn't overlap with other projects?
Yes, you have raised a very important question. It is true that various funds led by government agencies are currently operating, and we are actively seeking ways to differentiate from those. For example, the National Growth Fund, which has been operating and investing since last year, aims to invest around 150 trillion Korean won. Its main focus is centered on loans or indirect investments through funds. In contrast, when we speak of the Sovereign Wealth Fund, we plan to invest primarily with long-term patient capital and directly make equity investments rather than simple indirect investments, which differentiates it. Rather than solely focusing on differentiation, we're also actively considering co-investing together. If necessary, we use the term relay investment, where we actively consider taking over positions when major public funds seek to exit.
Does that mean that it would actually include the possibility that, given the funding is going to flow into stocks initially for this entity, that you could see actually buying, say, chip makers like Samsung, SK Hynix, or contributing to projects that some of these companies are involved in?
Rather than investing in large enterprises like Samsung or SK, our interest lies in companies beyond the very early startup stage, what is typically referred to as Series B. Series B refers to companies whose business models have been somewhat validated and are at a stage ready to scale up. Among such companies, we are considering relay investments to support them when early-stage funds linked to public institutions exit. As for companies like Samsung and SK, rather than government investment, we understand that many international firms are already interested in them, and the government currently has no plans to directly invest in large conglomerates like Samsung or SK through the Sovereign Wealth Fund.
South Korean Deputy Minister for Innovation and Growth Min Kyung-seol speaking exclusively to us here at Bloomberg. And of course, you can check out that Bloomberg video on the Bloomberg Video Hub. Subscribers can explore live streaming news, also these past interviews, not to mention TV shows as well. Check it out, bloomberg.com/videos. Right, the AI trade drawing investors back to Taiwan. Foreign funds have returned to Taiwanese equities while selling Korean stocks. There are bets now that Taiwan could offer a more stable AI investment story. Bloomberg's Asia Equities reporter Sang-mi Cha joins us with more on this. And we've been talking about this phenomenon recently, Sang-mi, because you would think that both economies are sort of the bellwether for the AI boom, and yet Taiwanese stocks are seen as safer at this point. Why?
That's right, Shery. Taiwan and Korea, they have sort of been that paired trade always, but not since the July rout. We're seeing, the foreign investors actually turned net buyers of Taiwanese equities last week after, they have accumulated $1.7 billion so far this month, compared to where they dumped $6.2 billion in Korean equities. So you can see that recovery story since the July rout is just diverging between these two markets. And of course, since July, they both have lost quite significantly, but still are up 50% so far this year. And it is just that big rebound that we're seeing in the Taiwanese equities. And it is not just in the foreign investors coming in. It's really also have to do with the earnings revision. It was the first time in almost a year since Taiwanese equities actually got revised higher in terms of forward earnings. So they're up 9.5% compared to 7.4% in KOSPI equities, so KOSPI members. So you're seeing that investors are trying to bet more on these Taiwanese breadth that we're seeing, the foundry in TSMC, but along with the hardware supply chain that's very wide. The entire supply chain, things that are in your Apple and in your iPhone is actually coming from Taiwan. Investors are telling us. When compared to Korea, a lot of the businesses there are quite cyclical, which means you're going to have bigger swings there.
Yeah, and you can see it on that graph comparing the KOSPI with the Taiwan Stock Exchange, right? I mean, that incredible drawdown that you see in the Korean stock market, about 40% since its June peak. But wouldn't you think that that would lead to some bargain hunting at this point? But that's not happening.
Yeah, when you look at the valuation itself, you're right on that KOSPI is extremely cheap right now. It is traded at this it's the record discount compared to the TAIEX index. And it is true that investors have told us directly that they have, some of them have taken advantage of this July rout to actually, add some of these undervalued names in Korea. But they're not doing that in just Hynix and Samsung. They're doing that widely across sectors, and that's why you're seeing some of the rebound in the small cap Kosdaq as well. They're talking defense, industrials, and financials. But again, the underlying question is the same for the two markets, right? Is the AI spending going to monetize? And so that means that right now, investors are betting on the stability, right? When you look at just the valuations, they're saying buy Korea, but when you look at the risk-adjusted stability, investors are choosing to pay more for that stability at the right time right now.
Bloomberg's Asia Equities reporter Sang-mi Cha with the latest on these very tech-heavy indices across Asia. Of course, we'll also be watching for the Japanese market opens coming back from a holiday. So we'll be watching perhaps a reaction and the follow through with these stocks, not necessarily having priced in the news from NVIDIA's $500 billion funding when it comes to that huge AI deal with Wall Street. We also have to digest results from CoreWeave, Supermicro. We had Supermicro surging after revenue forecasts beat estimates. CoreWeave also seeing quarterly sales more than doubling, and these Japanese ADRs closed higher in the U.S. session. We'll be ready for the open in about 10 minutes. This is Bloomberg.
Well, Suno is the largest of a growing crop of startups using AI to generate music. The company has signed up more than 1 million subscribers and generated over $100 million in sales last year. But Suno's meteoric rise has vexed artists and major record labels, believing the company has trained its models on copyrighted material. For more on today's Big Take, let's bring in Shaw, who leads our media and entertainment coverage. And, you know, there's such a big existential battle at the moment between artists of all platforms and all genres against the use of AI. So why has this particular platform gotten so much traction?
Well, because it's the biggest right now. So they created a pretty cool tool that allows anyone to generate a song with a simple prompt, right? You can type in a few words and it'll generate a song, or you can give it very detailed instructions in terms of different instrumentation. You can upload music that you record on your own and have it manipulate it. And that's proven to be quite popular with users. You know, that has also put a target on its back when it comes to lawyers, artists, and the big music companies. So a few years ago, the 3 biggest record companies in the world all sued it. One of them, Warner Music, has since settled with them, but Sony and Universal are still in active litigation. And so it's a really interesting story about this company that, you know, thinks that AI is going to change the music business, but is itself becoming a villain pretty quickly.
Is there legal precedent at this point in terms of whether scraping copyright material, whether you're talking about music or you know, written material otherwise, is actually legal?
You know, it's an open legal question. You know, there's 2 aspects of what we're talking about here. There's the actual training of an AI model on copyrighted material, so that's sort of feeding songs or movies or YouTube videos into the model so that it learns how to kind of eventually spit stuff out. And then there's the output, which is what you can consume. I think most people would agree that you can't just, you know, spit out a replica of something that exists, but the training is still up for debate. There are some who believe that it's totally legal, you know, Suno being one of them, and then obviously the record labels feel that they should get paid if you want to train on their work.
Are we seeing sort of any big name proponents of this technology at this point?
Well, look, obviously, there are a lot of companies that have started and are using AI music in some way. So Suno is one of several. There's something called Udio, there's Clay, Spotify and YouTube are developing kind of AI music products. You know, even though it's divisive in the artist community, like I said, Warner Music, which is one of the 3 big majors, has done a deal with Suno. Universal has done deals with Udio. All of them have done deals with Clay. I think the question is, or kind of, what is the nature of those agreements? I think everyone sees that, you know, people are going to want to use AI tools to make music, but how are artists going to be protected and compensated in order for that to be, you know, fruitful for them instead of damaging to their careers?
Shah, really good to have you with us. He oversees Bloomberg's media and entertainment coverage. As we head towards the market opens at the top of the hour, Japan is coming back from a holiday. Not a lot of movement in the future space. Kospi futures pointing higher of more than 1%. Of course, we had strong AI earnings in the Wall Street session. Sydney futures to the downside of 0.4%. The market opens are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens after some strong earnings. Heidi, when it comes to the AI trade, we're talking about CoreWeave, Super Micro as well, surging in late trading. But at the same time, will we see the macro reassert itself? We're headed towards US CPI numbers, which will really decide the direction of where the Fed could go from here, given weaker than expected US jobs report, and of course the upside on inflation from higher oil.
Yeah, this is a high-stakes inflation print, isn't it, Shery? And you're very right to point out that this could really shake up these Fed expectations. And of course, that energy print will be particularly interesting as we are, as you say, continue to watch for that pass-through of oil prices. We are hearing from Pakistan potentially of getting closer to a deal to reopen the Strait of Hormuz between the US and Iran, and also Iran and Oman as well. Both parties have been really hardening their positions over the last few days. And Shery, in the meantime, if the trajectory changes for the Fed, obviously big implications for the Bank of Japan as well, with that 160 level looking precariously close for the yen now.
Especially now that we have markets pricing in a two-thirds chance that the BOJ will actually hike rates in September. In fact, Bloomberg Economics bringing forward their call for a hike to October instead of December. But you said it, Heidi, we're talking about the Japanese yen, very close to that 160 level against the U.S. dollar. Again, the very important threshold after we saw the intervention from the U.S. and Japan, joint yen buying for the first time since the 1990s. And that, as we approach that 164 level, a 40-year low against the greenback. But will we see some more action coming from authorities here in Japan is a big question. And will that even make a difference, right? Given, of course, the uncertainty around the BOJ hiking trajectory that I just talked about. But take a look at the Nikkei. The topic's a little bit of divergence there. We continue to watch a little bit, perhaps, of that follow through, given that the Japanese equity markets are coming back from a holiday. We had seen NVIDIA's announcement of that $500 billion AI financing deal with Wall Street. So we might be seeing a little bit of that impact in today's session, although we saw a little bit of those credit jitters ease a little bit for NVIDIA after the CEO Jensen Huang sort of explained that perhaps NVIDIA will not be as directly exposed to all of that spending. Take a look at some of the tech stocks coming online in the Kospi, because we had seen a lot of volatility for this market, right? We're talking about a drawdown of about 40% or so since its June peak. We're seeing Samsung, SK Hynix gaining early in the session today. This, as we continue to see a little bit more upside, a little bit more calm in this market. We have now heard from the Deputy Minister for Innovation and Growth in South Korea talking about a fresh $700 million investment into a new sovereign wealth fund in South Korea for strategic sectors just for 2027. So we'll be watching how those industries grow in South Korea. But we continue to see the weakness in the Korean won. That's been the divergence in this market, right?
Yeah, divergence is what we're watching at the moment, right? Because we continue to have this, rotation and volatility in that tech trade as well at a time where broadly we're seeing quite a bit of risk aversion. But this is a picture as we have that sort of anticipation ahead of the US inflation print. That 3-year auction seeing some pretty strong demand. That was the highest yield overnight since 2025. We do see that sort of shorter dated bill front looking like we are seeing pretty robust demand there. But broadly speaking, as you said, we're just watching and waiting for that inflation print. Brent crude coming online higher by 0.4%. So we are seeing oil prices hanging on to gains for going into a fifth day now as we continue to monitor these efforts to get to a deal over the Strait of Hormuz. The Defense Minister of Pakistan saying that the two sides are close to some kind of arrangement, but some of these sort of headline-driven moves that we're seeing in oil markets at the moment very sensitive to these latest developments, despite, of course, not a great deal of tangible progress being made. At the moment, we're seeing Australian stocks coming online about 0.4%. We'll have a look at CBA a little bit later after those earnings came in stronger than expected. Banking stocks, though, will be on watch broadly today to see if some of the other big players fare as well. Let's bring in Xi Qiao, who's a financial advisor and managing director at UBS. Really great to have you with us. So, as usual, there's a lot of cross currents going on for investors. How big is this inflation print in terms of broader sentiment going forward for you?
I think we're just not as concerned with the inflation at this point. I mean, we're still pretty focused on the overall market and the strength of the economy. So, I mean, even with inflation where it is, I mean, the Fed is still on hold, and the progress in the hopefully the U.S.-Iran negotiations and AI growth, we feel like the economy is still going to be pretty much intact, and we're positive and very optimistic towards equities, even though it might be bumpy, but still we have a pretty good price target for the S&P reaching about 8,200. So I think investors should still continue to stay invested, and hopefully the AI and the strength of the markets will continue to help push equities higher.
Yeah, tell us about how you're viewing the construct of the AI, the hyperscalers, some of the developments that we've seen in that space, particularly in the US, because there's been ongoing concern about obviously the amount of infrastructure investment, capex levels, but then we're also seeing, the rotation of huge amounts of funds in these circular funding arrangements.
Right, absolutely. I mean, I think, lots of concerns, but we remain constructive on the AI growth story. But we believe investors will, manage the concentration, and we're hoping that investors can start to manage some of the concentration by just diversifying out of, complete AI stocks, but maybe into other sectors like healthcare, industrials, financials, even though we feel like AI is still going to push the growth for the next probably 5-10 years, but there's still a lot of room for investing in other defensive sectors as well.
One of the non-US markets you like is China. Tell us about what you're finding compelling within Chinese equities at the moment. Is it that AI play on the basis of the gap that is being very quickly closed?
Yeah, absolutely. I mean, Chinese equities, we think China, has a lot of room for growth in terms of the tech equities. But, outside of China, we want to focus on, India, Japan, Europe. Those are also a lot of good valuations in some of those markets. So I think, of course, China's going to drive a lot of the growth just because where it's located and because all the investments they are also making in AI. I think it is probably worthwhile to stay with some of the Chinese larger tech names, but also diversify among surrounding countries. I mean, South Korea was also a big winner in the last few months. But I mean, we're currently neutral, and we are now more attractive on India. So I think China, India, some of the surrounding countries are also a good place in this market, especially with the AI growth.
When it comes to developments on the ceasefire or an ultimate peace deal, or at least, a specific deal to reopen the Strait of Hormuz, is that meaningful for markets at the moment? Do you see any kind of big change that could come through?
I think negotiations are improving, and we do absolutely hope for a kind of resolution. But we feel like eventual agreement with Iran, will likely keep pressure on oil by allowing more supply to reach global markets. It's going to take some time. So, this can definitely support gold by easing inflation concerns and reducing the risk for further central bank tightening. So, there's going to be some impact, but I think eventually there will be a resolution, but it's still going to be a kind of a bumpy road ahead to get there.
What do you like within bonds at the moment?
Well, we like a lot about bonds. We think this is a great time to lock in yields, especially with US corporate bonds, 5 to 7 years. We prefer high quality, also emerging markets. But I think, where rates are right now, this is a really good time to diversify your portfolio within bonds and focus on the high quality corporate bonds.
We talked a little bit about the sort of broader opportunities within China. I know that India is one of them. Are you constructive on broader EMs as a result?
Yes, emerging markets, absolutely. We think EM has had a good run this year, but a lot of that is volatile as well. It's dependent a lot on China, especially on China. So really have to see a stronger recovery in China's economy. And I think, EM is usually, EM, emerging markets usually is a smaller allocation for us. I think it's good to be participating, but we're still focusing more on just the core US portfolio at this point, and some of the larger developing markets, such as China and Europe and Germany and the Eurozone overall.
Korea has, of course, been front and center. You've downgraded from attractive to neutral. Is that over the froth over the AI trade for you?
No, that's actually a really good point. Korea has certainly done very well with the memory companies, and but that a lot of that has run up pretty high in a short time, and we have a lot of clients are always favorable on the semis and equipments and foundries, but we feel like focusing, if you want to diversify among the semis, focusing on some of the compute names within semis, and there's a lot of opportunities that we see in smartphone makers, payment networks, data centers, REITs, and also some select consumer electronics. So a lot of that, is still a good play for some of the Korean companies. But just to diversify out pure semis, these are some of the opportunities that we see.
Xi Qiao, always great to have you with us, financial advisor and managing director at UBS. We are taking a look at a couple of the top stories or the top movers that we're seeing in Australia at the moment. CBA is obviously always one when it comes through with numbers there. Profit topping estimates. We see both home as well as business lending. Those units are growing there. The mortgages and loans to company side of the business is strong as well. Cash profit climbing 7% in the 12 months through to June. 10.98 billion is what we came through with, compared with 10.85 was the average in our survey of analysts there. The final dividend, I should say, also being raised to $2.70 per share. So $5.05 is that full year payout. The return on equity increasing 50 basis points there as well. So pretty strong numbers out of CBA, despite, of course, we're operating within a backdrop of the nation's housing market weakening quite dramatically, given those tax changes that we've seen for property investors and 3 rate hikes from the RBA, and potentially more to come despite that weakness. The other stock that we're watching is Suncorp. Some pretty big trading moves out of that one as well. In fact, the most in 2 years. Trading volume has tripled in this session alone. We saw full year net income coming in at just over 1 billion Aussie dollars versus expectations of 1.8, but we are seeing quite a bit of upside there in this stock at the moment. There's a $250 million Aussie share buyback that was announced as well. More ahead here on the Asia Trade. This is Bloomberg. Take a look at how Brent is coming online in this session. We are seeing gains now as we have oil holding that 5-day gain. Traders still watching those efforts to reach a deal to restore energy flows through the Strait of Hormuz. New York traded crude up by about 0.5% there as well. We're hearing from Pakistan's Defence Minister Khawaja Asif saying that the US and Iran are close to some sort of arrangement over the Strait of Hormuz. At the same time, of course, the two sides appear to be hardening their stances. For more, Bloomberg editor Michael Heath joins us now. We're also hearing maybe a progress between Oman and Iran as well in those talks, but the indications from both sides have not exactly been one of compromise over the last few days. No,
it's a really unusual sort of scenario where you've got the two protagonists sort of hardening their positions, very much so. The US talking about compensation for 50 years of terrorism and that sort of thing, and obviously Iran wanting the side of the MOU to be unlocked. And then also Iran saying that, reiterating in a way, but perhaps a bit stronger, that its negotiations with Oman about managing the Strait of Hormuz has nothing to do with it being opened or closed. But then we also need to remember that Pakistan was a fairly important mediator in what's been going on, and there have been, cases during the course of all this on again, off again, where what's been said publicly isn't exactly the same as what's happening privately. We don't know the status of how Iran's holding up economically in terms of this blockade. We do know that there's factions within it, so does one faction, at the moment it seems the hardliners to sort of have the upper hand, but whether that could change as well. So yeah, look, it's clear as mud, really.
In the meantime, of course, we've got the US inflation print coming through as well. Has it been surprising, perhaps, that there hasn't been more pass-through from that pressure from oil prices? Because clearly it adds to the political pressures domestically.
It does, but look, there's been some. There was an interesting Bloomberg report, sort of looking at various amounts of oil that has been managing to get out through different channels, and while it's obviously down quite a lot from from what was what was coming through pre-February 28. The oil is getting to the market. There are transfers happening in the Gulf of Oman. So some ships it looks like the UAE is sending ships through without its transponders on, and then there's being a handover of oil. So there is oil moving, but the amounts there and the costs and these sort of things, I guess, are the questions. But yeah, look, it is really surprising how little the impact has had, particularly in the US. Which obviously does produce a lot of oil itself, but nonetheless, we're in a global market. So, yeah, it's an unusual one, and whether it takes time. I mean, the Australia Central Bank was saying this yesterday, that it could be that as the months go on, this sort of accelerates and pass through comes. But yeah, we're in a really, really unusual situation.
Bloomberg editor Michael Heath there with the latest on the Iran war and, of course, what's happening to oil prices. And we're following the energy assets across Japan as well, because the energy sector was leading the gains on the Nikkei. But at the same time, offsetting those gains, you have the likes of healthcare, consumer discretionary that's down. So right now, we're unchanged at the moment, pulling in both directions. We're watching some of those tech stocks as well, because we had Supermicro, we had CoreWeave, really a rally in the after-hour session on Wall Street. So those AI component makers here in Japan, not to mention semiconductor testing like Advantas, anything related to the AI trade, we're watching. And of course, the Japanese yen. I mean, who can forget the Japanese yen? We're very close to that 160 level again. Your Verizon analysts, though, now saying that joint U.S.-Japan intervention has set the stage for a broader yen rally, forecasting that the currency could strengthen toward 125 against the dollar. Paul Dobson is Bloomberg's executive editor for Asia markets. Paul, but then, I mean, if you put a time frame of the next 10, 20 years, you could definitely get to 125. I think they didn't necessarily think of a timeline right there. What's the risk around the yen now that we're very close to that 160 again?
Yeah, morning, Shery. So I think it's quite interesting that we're hearing these comments from Eurizon. It's Stephen Jen, who's very well respected in currency markets globally, with the view that this is a watershed moment, the US and Japan intervening together in currency markets. He's basically saying, the market might test them some more, but it's not going to win when you have that sort of force behind it, which I think is exactly what Scott Bessent and Takaichi would wish for as well. But on the other hand, the market doesn't seem completely convinced about it just yet. So we are weakening again towards that 160 level. The market is wondering whether, we're actually going to see some changes in Japanese policy that will lead to a stronger yen over time. And most importantly, it would like to see the Bank of Japan get on with raising interest rates. That could trigger that longer-term turnaround from what the market views as very undervalued levels, but at the moment it's still that kind of trend for an outflow from the low-yielding yen into higher-yielding assets that is the wave that the authorities are having to fight against.
And over the next 24 hours, what are the risks around U.S. rate differentials reasserting themselves on the U.S. dollar and the yen, given that we have those CPI numbers out of the U.S.?
Yeah, exactly. So I think there'll be a few people in Japan burning the midnight oil, staying up to watch those CPI numbers later, Shery, because, again, they're going to be quite a strong determinant for what the market views as the Fed's future rate path. And if they're high CPI figures and they make it more likely that the Fed is going to need to raise interest rates, that's going to be bad news for the yen. It's going to put it back under pressure again. So it may see us moving towards that 160 level. On the other hand, it may revive the need for more intervention. So we could see some pretty volatile price action overnight. The market doesn't know in which direction and how far, but it does know that it is possible that we're going to see quite a lively session overnight in the currency markets.
When it comes to trying to understand where the Fed is going from here, given that we saw those dissents in the last FOMC and the fact that, of course, we are also following on the other side, the softer than expected U.S. jobs numbers. What are the expectations right now?
So the market is still priced or leaning towards the Fed hiking at some point, despite the fact that we had the very soft or the negative payrolls numbers at the end of last week. The impact on the Treasury market was very fleeting, and we've kind of already taken away all of that again. So the bias in the treasury market, it's a lot like the yen actually. You know, the market wants to go in a certain direction at the moment. You can kind of feel it, and it wants to see higher yields. It's minded to think that either the Fed is going to have to hike or inflation is going to risk getting out of hand. You know, we've got the added background noise from the rising oil prices, which is a more real-time indicator of future inflation outlook as well. That's for adding to the uncertainty in the mix too, and so pushing up higher yields and raising the prospect that the Fed will either have to act now or it will have to do even more later. That seems to be the market mentality right at this moment.
Yeah, and of course that has implications for the broader U.S. economy and markets. Mortgage rates go up. We're hearing that existing home sales now fell to a 3-month low as well. Paul Dobson, good to have your insights. Bloomberg's executive editor for Asia markets. As we look ahead for more on this show, the Asia trade is coming back. This is Bloomberg.
Take a look at what we're watching when it comes to Australian assets at the moment. We are seeing a bit of downside, 0.4% there, with, of course, the exception of some of the earnings-related names like CBA and Suncorp also trading to the upside as well. The Aussie dollar holding steady at over that 70 US cent level. Of course, we are really just awaiting to see the impact of that US inflation print a little bit later. But in terms of one of the stocks that is doing well today, the biggest lender in the country, Commonwealth Bank, reporting full-year profit that topped estimates thanks to stronger mortgage and business lending. Also raising its final dividend. Our Bloomberg Intelligence senior industry analyst Matt Ingram joins us now for more. So given the property market and the loan market headwinds, what's the broader outlook for CBA?
Yeah, Heidi, it's a good question. The market's pretty bearish on CBA for a number of reasons. We don't think that's justified. Margins look really good in 2027 with the RBA rate hikes, and they've been growing their business loan book so strongly, and that's really healthy for profitability as well. So yes, the market's concerned about this slowdown in mortgage applications, but CBA is all about business lending at the moment, and that's really good for profit next year.
So that's where the further growth is going to come from in terms of the loan book?
Yeah, and look, longer term, we're pretty bullish on loan growth anyway. Population growth, inflation, the government's housing targets, these are all very good things for housing loan growth as well. Conversations with our economist James McIntyre about the impact of the tax changes, that might actually be a storm in a teacup as well. So the market's getting pretty excited about the slowdown in these mortgage applications, but we think longer term housing demand is going to be very strong, and that's good for CBA as well.
What was the reasoning, do you think, behind the cancelled buyback?
That's the billion-dollar question. We think it must be down to the strong growth in the business lending book. That's very profitable, but it's also very capital intensive. There was an upsurge in credit costs in the second half. That doesn't look good if that's why they cancelled the buyback, but we think it's more about loan growth in the business book.
It's the biggest threat looking forward.
We just touched on it a minute ago. It's credit costs. People don't know when this Iran war is going to end, and we've said that remains the biggest threat to the investment case for the Australian banks generally. We're very bullish on earnings across the sector, and we think that credit costs, if this war plays out, if fuel costs remain elevated, and if we see an unemployment problem, then that's a threat to the sector. But that's not our base case. I guess if the RBA cuts aggressively in the first half of next year, that's a problem for CBA as well. But again, that's not our base case.
No. Do you see that resilience across the other big lenders too?
Yeah, I think so. ANZ's lagging. There's a lot going on at ANZ. But ANZ aside, we're seeing really good loan growth, particularly in business lending. We're seeing OK credit costs, and we're looking very good for margins across the board. Non-interest income, so fees and things like that, we saw a big drop in those after the Banking Royal Commission, and that's really settled down now. And we're seeing decent growth in that as well. Expenses, maybe a bit of a risk, but the banks, I think, have gone through that inflation spike, and they're looking OK on that too.
Matt Ingram, our Bloomberg Intelligence senior industry analyst, here with us with the latest on CBA. More ahead here in the Asia trade. This is Bloomberg.
We're seeing mixed reactions to the earnings results of some of these Japanese stocks. Rakuten plunging more than 10% at one point. Operating income missed the analyst estimates, but it was still the first profit in 6 years. The fintech segment seeing profit growth of around 60%. Sanrio seeing its worst day in more than 12 years. They reported operating income that missed the average analyst estimate, so you're seeing declines of about 16%. Also follow Square Enix. This is a gaming company behind Dragon Quest and Final Fantasy series. They're jumping the most in more than a year. They came in with operating profit that beat consensus by about 44%. And Haidi, Bloomberg Intelligence, now saying that this company's unchanged guidance for 2027 looks actually conservative.
Take a look, Shery, at some of the other tech headlines that we're tracking this hour. And CoreWeave shares jumping in late trading as the AI spending frenzy spurs faster than anticipated sales growth. The company sees sales of $3.45 billion to $3.6 billion in the third quarter, above analyst expectations. The provider of AI computing power says its backlog stood at $104 billion, suggesting AI demand remains strong. Supermicro computer shares also higher after the bell, the company forecasting quarterly revenue that beat even the highest analyst estimate. It also raised its full-year outlook, citing continued demand for AI infrastructure and its NVIDIA-powered servers. Apart from riding the AI boom, Supermicro has also been working to boost margins and to cut costs. Bond traders have dialed back measures of credit risk tied to NVIDIA after the company said it would limit its exposure to a $500 billion financing plan. The yields on NVIDIA's 5.625% bonds maturing in 2056 slipped to 113 basis points above comparable treasuries. The price of its credit default swaps also declined, Shery.
Heidi, let's discuss everything to do with tech, the investments around the AI trade. I'm bringing Neil Shah, Vice President of Research for Counterpoint. Neil, great to have you with us. I mean, there seems to be a sigh of relief in the credit markets when it comes to NVIDIA and how perhaps they're not as exposed as they initially thought. Does this mean that the risk for NVIDIA falls? What are some of the concerns around circularity as well when it comes to some of the investments that NVIDIA is making right now?
Absolutely. I think this is a very clever way of getting the debt off the books and creating a special purpose vehicle which can take most of the risk and be a conduit between the actual infrastructure players, which are renting infrastructure, and the compute to build the AI and train the AI and even have large-scale inferencing done. And everything is boiled down to the token economics of the model. So if they can have a good margin at the demand side, I think they can repay the leasing fee for the compute, and NVIDIA gets a revenue as soon as possible as it delivers the compute to these SPVs.
Does it have the risk that you're actually transferring some of the leverage that we've seen from hyperscalers to just a sector of the financial market that might not be as transparent?
I think it's sort of translucent, I would say, if it's not transparent. I believe most of these players are, if you look at the overall capex of the industry, right? So it's almost reaching $700 to $800 billion per year for the top hyperscalers. And when you look at this $500 billion fund with the different players, it actually is an extra cushion for a lot of the other players. It's still, because it will be spread out over the few years. So eventually it's just 20 to 30% of what we are seeing annual spend from hyperscalers. So there will be long tail players which will be requiring some financing. Maybe it's a tier 2 data centers or tier 3 data centers. So I would say this will drive more of a flywheel effect for the entire ecosystem, where we will have more players. The finance could be enjoyed by some of the big hyperscalers who are maybe cash-strapped, or some tier 2, tier 3, as I said.
Yeah, it's been interesting to see this development, right? I mean, you have NVIDIA bringing in private capital. You have, of course, a big reliance on debt, like we've seen from CoreWeave, for example. I mean, they did very well on their latest results. But at the same time, Intel's latest news on trying to raise a very large equity raise. How much of a problem right now is when it comes to capital availability and AI financing, and will we see these different models also arise from all of these different projects?
Yeah, absolutely. You hit nail on the head. So everything is connected, right? If you want to build, if you want to invest $1 trillion in infrastructure, you are investing like 50% goes to the servers and 80% of those goes to compute and memory, right? And for building that, for that insatiable demand, you need to have foundries which can churn out those leading edge chips, right, from processors to memory. And if you look at TSMC and all these big players are already maxed out with capacity. And that's why you need newer players like Intel to expand and take up the foundry services and churn out those chips on time. And that's why to do that, they also need enough capital to buy this equipment from ASML of the world to produce these chips at scale, right? And that's why I think since the Intel stock has been doing well, it had some cushion to leverage that and use that money to influx into the overall capital expenditure for their foundry services.
At least when it comes to this earnings season, are you seeing more signs that perhaps the demand for artificial intelligence compute is out there?
Absolutely. There is a lot of demand we can see, and we are just scratching the surface right now. If you look at the amount of productivity gains for right from like content creators, developers to enterprises, we are seeing a lot of productivity gains. We are seeing how much they can do more with AI. And it once you start burning tokens and create those software and everything really fast, it's very difficult to go back, right? And this will be more of a snowball effect where you keep on building and everything becomes a token economy, basically, right? And we are just, as I said, touching the surface. Maybe 5 to 10% of the entire world population or the businesses are still using AI. Imagine when everyone starts using AI at scale, and then you have multiple agents as well, which are per company, per developer, there are hundreds of agents doing automated tasks. That will burn a lot of tokens. So it will require a lot of AI token generation infrastructure. And that is where you see all these investments going in.
Neil, going back to the issue of circularity and the fears around which metrics we should be watching when it comes to some of those red flags. Are we talking mostly about free cash flow, which some of the earnings results from the hyperscalers, for example, led to that negative reaction, for example, Alphabet, Google? Are we talking about credit spreads, like we saw NVIDIA, for example, reacting to the $500 billion of AI financing and Wall Street partnership? Which ones are you watching?
So we are watching multiple levels. We are looking first at the demand side because that is the key driver. How much of the revenue is being able to generated by the hyperscalers with respect to AI. That is a key metric we need to track in terms of demand. Coming back from demand side to supply side, you have to also then look at the bottlenecks which are there for building this infrastructure to cater to that demand, right? Whether it's regulations or whether it's power or whether it's the availability of foundry services to build chips, right? Manufacture chips. So all of these are different, I would say, pointers we are watching at every stage because everything is connected, right? You have to look at end to end, and obviously the capital expenditure on of the books is very important to track as well. And that is why you will need a lot of these different creative deals to finance and keep the train going.
Neil, recently we also saw some concerns around the geopolitics side of things, with the U.S. now proposing this ban on Chinese optical modules, for example, at a time when we've continuously talked about shortages in different sectors of the AI trade, whether it's GPUs, memory, networking, power. What are some of the biggest red flags and biggest concerns in the next few years that we need to watch out for?
That's a very good point. So if you look at, there is too much dependence on, I would say, two economies, either it's US or China. It goes for compute and memory, it has been US. For manufacturing and for optics, for like so even materials like in phosphide, right, which goes into networking. And as you move from copper to optics, as you build massive rack scale systems, rack scale infrastructure, you need all those cutting edge modules, which are really manufactured precisely by a lot of Chinese ecosystem, and they are expert at that. So you will see some bottleneck in these different waves. The first bottleneck we saw was with compute. Second one was with memory, and you see the memory stock prices going up. Third, we'll see in terms of the CPU glut, which we are seeing in compute. Fourth is the network and optics, which we are seeing with these Chinese players from regulatory point of view, as well as from the raw materials point of view. There is a wave, there is a possible glut coming in that scenario where the capacities are fully booked. And the fifth is going to be the power semiconductors within power ecosystem and moving to newer materials. So these are the 5 waves you will see, which builds the AI infrastructure, and you'll see these different waves, and many companies will make money, become trillion-dollar companies. Some will be just acquired.
Neil Shah, good to have you with us, Vice President of Research at Counterpoint. And you can get more on the biggest tech stories on the Bloomberg Video Hub. You can also check out past episodes of Bloomberg Tech Asia, other shows as well. Bloomberg.com/videos is the address. More ahead. This is Bloomberg.
Well, Tencent reports earnings later today with its AI workplace assistant WorkBuddy expected to be a key focus. Investors will also be watching to see whether the product is gaining traction, helping Tencent close the gap between rivals in China's AI race. For more, let's bring in Bloomberg's Asia stocks reporter Jeannie Yu. So, Jeannie, what's been the consensus when it comes to Tencent earnings at the moment? What will you be watching?
Yes, I think investors still expect a good quarter, relatively good quarter for Tencent, which means the revenue is going to grow about 10% from a year earlier, and profit is going to see another 5% growth year on year. So, which is not bad, especially on the advertising and mobile gaming side. Most people think Tencent is going to be at least in line with the consensus. I think the key things to watch, there are a few. One thing is the WorkBuddy, which is actually China's most popular desktop AI assistants for the white collars. I think this is like a very big highlight for Tencent when investors may request more data to be released about like how WorkBuddy has been trending in China, how much users, for example, like annual recurring revenue forecasts for the apps. Any comments on that? I think is going to convince investors about Tencent's efforts in expanding the AI agents across its empire. The second thing, I think it's still about the spending, because the AI race in China is getting fiercer and fiercer, and Tencent needs a lot of investment to grow. Is, for example, the AI models, the AI agents within that Weixin, all of them are actually require very big capex. So investors still watching like how much, like whether Tencent is going to raise their capex estimates, and in that case, like how soon can Tencent get any return from those massive investments? Those would be the key for the sentiment over Tencent after a big correction recently this year.
Yeah. You can actually see the stock now sliding more than 20% year to date, so not surprising we have valuations near record lows for Tencent. But finally, perhaps a sort of rotation broadly in the markets from hardware to internet platforms. Could we expect this to continue?
Yeah, indeed. There has been like a very big rotation from the AI AI hardware, the words, for example, like Chinese internet platform, starting from end June. I think this is a global phenomenon, not just like China specific, but what's making China more interesting is like all the Chinese internet platform, they're having valued like they are not an AI company. And for example, like Tencent's valuation is still hovering around record low. So I think the valuation is definitely one of the reasons which could help those stocks attract more fund flows, making the rotation to continue. I think the second thing to watch is indeed how the earnings season will play out for those internet giants. With JD, Meituan, they are going to report results later this week. I think this would be key for the sentiment. So if there is any good comments, for example, if there is positive signs that shows China's e-commerce is actually not as bad as people has feared, I think this is going to help the rotation to continue as well.
Our Asia Stocks reporter Jeannie Yu there, head of Tencent, and some of the other corporate stories that we're tracking this hour. Adani Group has secured an $800 million loan from international lenders to fund its growing data center business. The deal signals renewed confidence in the conglomerate following the dismissal of US fraud charges against its founder, Gautam Adani. Lenders include Mitsubishi UFJ and Singapore-based DBS Group and Clifford Capital. US-listed shares of Singapore-based Sea surged after the company raised full-year earnings guidance for its e-commerce arm, Shopee. The upgrade suggests that Shopee is holding off intense competition from rivals including TikTok Shop, Lazada and Temu. The company also reported ad revenue jumping 70% in the second quarter. On Holdings stock fell the most on record after it posted disappointing second quarter earnings. The Roger Federer-backed sportswear company posted net sales of 850 million Swiss francs on a constant currency basis. That missed estimates of about 881 million francs. The brand also watered down its sales forecast for the year, seeing growth in the low 20% range. More ahead here in the Asia trade. This is Bloomberg.
Take a look at how Korean assets are trading as we see the Kospi gaining more than 2%. Really extended those gains that we saw earlier in the week as well. The Korean won a little bit under pressure at the moment, headed towards that 1500 level. 1412 is the level right now. We've seen significant strength in the Korean won recently. It moved to a 10-month high against the US dollar. Some of those flows coming from investments into South Korea, especially perhaps from those flows from SK Hynix ADRs as well that are expected to be invested in South Korea, have helped with sentiment when it comes to the currency. Economists now revising their GDP forecast for South Korea, growth of 3.3% expected for this year. Haidi, perhaps not surprising given how much they're seeing in terms of the upside from anything to do with tech and semiconductors. In fact, information tech is the sector leading the gains on the Kospi in today's session as well. Economists expect a 3.3% expansion for 2026 as the government now says that it will be investing more than $700 million into a new sovereign wealth fund targeting strategic investments around AI just next year.
Take a look, Shery, at what we're watching when it comes to Australian assets. A lot of sort of sideline activity happening on as we expect that US inflation print to potentially have a meaningful impact for the path of the Fed, and that's going to drive the next move when it comes to the US dollar. So at the moment, we're seeing the Aussie dollar holding pretty steady at that high 70 US cent level there. We're seeing equities mostly trading to the downside. Some strong gains coming out of the utility sector, up by 2.5%, and financials and banks getting a little bit of a boost from some bright CBA numbers in particular, but broadly it is a risk-off session. We are also seeing some expectations that the Aussie dollar could fall shy of that 70 US cent level if there is sort of broader agreement in the weeks to come that the RBA will not follow through on these threats to hike further. That's a call according to ITC Markets that we're watching. We are also watching Kiwi assets at the moment as we really monitor the political drama over in New Zealand. This is a picture as we have stocks a bit lower, the Kiwi dollar trading a little bit softer there as well. We're waiting to hear from the New Zealand Prime Minister, Christopher Luxon, and he has now appeared at the podium as he faces lawmakers over the future of his role as Prime Minister. Let's listen in.
Good morning, everyone. As you know, this is an absolutely pivotal election with some very, very serious issues at stake for New Zealand. We think we have made tremendous progress as a government, rebuilding economic growth, financial discipline, restoring law and order, and certainly strengthening education and healthcare. But we also acknowledge that we have a lot more to do. Our plan to fix the basics and to build the future is a positive plan, a very positive plan to help New Zealand realise the innate potential that it has. There was a confidence vote in my leadership this morning at our caucus meeting, and I have the full support of our caucus. And our caucus is united and it is determined to win this election. Our focus is on National's positive plan to fix the basics and to build the future so that we realise the incredible potential that sits in this country and that we set it up for our kids and our grandkids so they can do better than we can. It's also an opportunity to frame the choice for voters, which is crystal clear on November the 7th. An opposition that wants to take New Zealand backwards, or a national government that wants to fix the basics and build the future and with a plan that takes New Zealand forward. With that, I want to say thanks everyone. We're going back to work and we're moving on. Thank you very much.
What about the directors? Right, New Zealand Prime Minister Christopher Luxon there appearing after that emerging meeting of his National Party lawmakers. Really, there had been a lot of questions over his political survival, but remember, a confidence vote had already been called by him back in April, which he obviously then survived. But he's saying that he has this time won the National Party caucus confidence vote again, so he will be staying on as Prime Minister. There has been question as to whether he's kind of the right person to lead the party into November's election, which is coming around very quickly. The polling has not really been in his sort of favour, struggling in those opinion polls with the weakness in the economy, which he addressed there, high living costs, rising interest rates, as well as some political gaffes as well. His personal popularity has also come into question. But we heard now just from the New Zealand Prime Minister Christopher Luxon there saying that he has won that National Party caucus confidence vote after being in that same position back in April, and that he will not be resigning. The messaging there very much was that they were going to get back to work, get back to rebuilding the economy after that emergency meeting in Parliament in Wellington. Really a bid, Shery, to try and quell the speculation about his position, of course. It's an uphill battle as we head into that election in November.
Yeah, especially as you said it, I mean, there are those economic issues that he needs to deal with, which the rest of the world is dealing with as well, right? I mean, we are headed towards the US CPI numbers that will really be a decider of perhaps what happens with the Fed's path forward. We did have softer US jobs. So what can we see in terms of the inflation numbers will be key at a time when the Iran war is sending oil prices higher. This is the picture across futures right now. Not a lot of movement, but do watch out for TAIEX futures and the Taiwanese market, because NVIDIA supplier Honhai, for example, is expected to post its strongest quarterly profit growth in a year. Of course, the AI trade remains, that boom continues, and that's giving a lot of upside to markets around the world. That's it from the Asia trade. Our markets coverage continues. The China show is next. This is Bloomberg.